Hey everyone, how's it going? It's Dan Russo, the Chief Market Strategist at Chaikin Analytics, coming to you from a snowy Long Island, New York, after yesterday's nor'easter slash blizzard. Going to be doing some digging a little bit later on, but first wanted to chat about markets, talk about what's going on. It's been a little while since I was on here and did one of these update videos, and a lot has played out. So I wanted to touch on a few things that I think are important before getting to the things that I think are relatively sideshow. What do I think is important? I think it's important in my note today, highlighting the fact that technology on a relative basis has kind of held support at a rising 200-day moving average and is beginning to outperform again. Now, why do I think that's important? Technology is the largest sector in the S&P 500. And the S&P 500 was able to grind higher while tech really wasn't participating. If you looked, especially mega cap tech, I take that back. Tech was participating. Mega cap tech, i.e. the XLK, was not participating. And the fact that the index itself was able to move higher in the face of a headwind of its largest sector not participating to the upside tells me that the underlying strength of the market is there. And I have to ask myself, what happens if tech gets in gear? We're going to hear from some big names over the course of the next couple of weeks as it relates to earnings. But look at a chart like Microsoft, went nowhere since the beginning of September and is starting to break top side. I'm not saying you should run out and buy Microsoft, but look at it. Take a look at Apple. Some of these names have tried to get going or kind of moving in the right direction. So I think that that's important. Number two, I think that consumer discretionary is important. Now, if you look at consumer discretionary on a relative basis, and it's in my notes every Tuesday, on the verge of a new high relative to the S&P 500. Why is that important? Well, number one, the consumer is important. We're a consumer-driven economy. Number two is there's more going on in consumer discretionary now than just Amazon. Now, Amazon does report earnings tonight, so obviously that can have a huge impact. Tesla is now part of consumer discretionary. So that becomes interesting. You're seeing a lot of retail names participate to the upside. Places that I shopped at as a teenager and when I was in college, right? The Abercrombie and Fitches of the world. Somebody mentioned Abercrombie and Fitch to me the other day, and I was baffled when I pulled up the chart and looked at it. I couldn't believe it. But some of these names are working, and that's kind of interesting. So rotation under the surface continues to drive a bull market. The cyclical reflation leaders that we've been talking about since the summer to varying degrees are starting to pause a little bit. The Finns have pulled back on a relative basis. Industrials, materials have kind of checked up a little bit on a relative basis. Energy, I still think looks interesting, but again, it's kind of stalled on a relative basis, even an absolute basis here in the near term. But while that's happening, we're seeing tech come on. We're seeing discretionary come on. Healthcare, would love to see that get in gear. Healthcare is weird. Not weird, it's just a broad group. There's a lot going on in healthcare, but it sticks to my point, which I've been pounding the table on for months, which is have a broad view, be open-minded. There's a lot more going on than just large, small growth value. There are a lot of opportunities out there. That's number one. Number two is I think those opportunities are starting to present themselves because of a few things. We've been waiting for the past couple of weeks for the market to work off overbought conditions. We've talked about it. We've written about it. We've now worked off those overbought conditions. And at the same time, we have this GameStop phenomenon that came into play last week. Some hedge funds lost a lot of money in the month of January. And it's unfortunate, but it's also an opportunity. And the opportunity is because as these funds are losing more and more money, they have to cut their risk across their entire portfolio. So they don't just have to buy GameStop to stop the bleeding. They have to buy everything else that they're short. And they also start to sell some of the names that they are long. They take risk down across the board. What happens then? Well, you start to see quality companies getting hit, right? Because everybody knows what these hedge funds have to do. Everybody knows that these hedge funds that are losing money have to de-risk. So what do? They sell those names ahead of the hedge funds, or they try to anyway. Then the hedge funds are selling, and it starts to feed on itself. Next thing you know, names like Apple have traded down to support levels. Next thing you know, names like Deckers have traded down to support levels. And you can go through the list, and you can see these names that have been hit. And that's the opportunity that we've kind of been waiting for. We don't care what catalyzed it. We've just been waiting for an opportunity. And the opportunity was when we were no longer overbought and when the major market ETFs were working towards oversold conditions. Well, so far IWM is very close. SPY is getting there, and the Qs are on their way as well. None of those are overbought any longer. They're all kind of closer to oversold at this point. So that presented an opportunity, and I've written about that to clients this week. Start to look for opportunities, especially in these high quality names that are just getting hit for a purely technical reason. People think these hedge funds have to sell, and they are selling. So I think that sets up opportunities. Finally, I'm going to leave it with this. The concept of stay in your lane, I think, is really important here. And GameStop has captivated the imagination of investors and non-investors alike. My 10-year-old daughter sat in my office this past weekend and asked me if we could look at the GameStop chart and asked me what was going on. Can we look at it on your charts, she said. So it's everywhere. And I always say kind of be careful who you follow, who you listen to. You should always do your own work, especially when somebody is an expert in another field and then they're getting out of their lane. There are a lot of people who are really smart, who are experts in their field. They may be experts in marketing and sports betting. They may be experts in cryptocurrencies and digital assets. That doesn't make them experts on the stock market. And it certainly doesn't make them experts on things like short squeezes, hard to borrow situations, gamma squeezes, and every other name that you've heard. Somebody told me today that there's a short ladder attack going on. Folks, I've been doing this for 20 years plus. I have never in my life heard of a short ladder attack. And I was a market maker. I traded in hard to borrow situations. I was names that were hard to borrow, names that were being squeezed. I've never heard of a short ladder attack. So just kind of be mindful, do your work, and just recognize that this is because of the internet and because of the way we communicate. There are huge opportunities to get out of your lane, for people to get out of their lanes, right? My lane is the equity markets and the asset markets in general, right? And as a technical analyst, first and foremost, if something trades liquidly, I can at least talk about the supply-demand dynamics. That doesn't make me an expert on it, right? I can talk about the supply-demand dynamics of a liquid foreign bond, right? By looking at the chart, looking at different timeframes, looking at volume. Does that mean I know the ins and outs of that foreign government? Absolutely not. I would never even opine on it. I can only talk about what I know, right? I'm a CMT. I'm considered an expert in technical analysis. Does that make me an expert in anything else? Right? No. So just because you follow me for markets, and I'm considered an expert in one aspect of the markets, doesn't mean you should listen to what I have to say about something like car mechanics, right? You wouldn't, run your brake job by me first. Out of my lane. Same thing. Apply it the other way. Just because somebody has a massive following, just because somebody's smart in a different field, doesn't mean they know the first thing about investing in the stock market, and doesn't mean they know the first thing about some of the situations that we've seen play out over the past couple of weeks. So just keep that in mind. That's my little rant for a snowy Tuesday here in New York. I hope that everybody is well. I hope that everybody is safe. I will be back soon with some updated thoughts. Talk to you then.